Welcome back on this, the final day of the first quarter. Stocks wrapping up the worst quarter in 4 years. Take a look. Major indices sliding into correction territory, down about 7 to 8% in the last 3-month period as oil prices have spiked, up better than 50% since this war began on Iran, February 28th. The Wall Street Journal reporting that President Trump says he is willing to end the war in Iran even if the Strait of Hormuz remains closed. The administration now looking to allies to help reopen that shipping lane. Joining me now is the chairman and CEO of Wells Fargo. Charlie Scharf is with us this morning. Charlie, great to have you.
Great to be here, Maria.
Thank you so much for being here. And I want to get your take on the impact of this war on the macro story and the economy. What have you seen from your standpoint?
Yeah. So separate out the pure economy from markets and what people are nervous about in terms of what the future holds. The economy is still extremely strong. When we look at it, consumers are still spending. Even with increases in oil prices, they're spending, 20, 30% more on oil, but they haven't stopped spending on everything else. Delinquencies are still strong. Employment is strong. Wages are still growing. Businesses are in good shape. So now it's still very early on, but just when you just look at the health of the consumer and the health of the businesses that we serve, which is pretty broad across the country, things are in really good shape. Now that's different than the markets, right? Where you've got markets that, on the one hand, you see drop in values, you see some nervousness, but you also have this debate about, are people factoring the risks of the war in enough? And markets have debates, and that will continue. But it does feel like there is a fragility or a nervousness in the markets, which you don't yet see in the economy, which, depending on how long the war goes on, will either turn out to be okay, or there could be a trigger which could make things a little bit worse.
Yeah. So it's people are waiting to see how long this goes on, I guess, and how significant the spike in oil prices becomes. In terms of lending, from your standpoint at Wells, what are you seeing?
People are cautious about borrowing. When I say people, I mean businesses are cautious about borrowing. Consumers are still borrowing roughly at the same rate that they were. Credit quality is still extremely strong. And the borrowing that we're doing at Wells is still within the parameters that we've always consistently done. But I do think then there's this nervousness of, should I be investing? Should I be growing inventories? Which is holding people back as they're waiting to see how the war at this point plays itself out.
And you've been right in the middle of the excitement of the economy, and that is data centers and financing some of those data centers. There is some worry that there's so much spending on data centers. What can you tell us about that? How big of an opportunity is that for Wells Fargo?
Well, I think to step back, there are reasons to worry out there. And, people always ask about what the future is going to hold. And the fact is, I personally feel very good about what the rest of the year looks like. Doesn't mean that there aren't a bunch of risks out there. It doesn't mean that we can't be wrong, and we got to be prepared for those. And when we think about just the amount of credit that's being extended in the data center space, when we think about, I'm sure we'll talk about the worries that exist within private credit, those are very real. But at the same time, there are real underlying businesses with real value propositions. And like anything else in life, there are going to be winners and losers. And we're all doing our best to make sure that we're financing and partnering with those that are going to be the winners.
I mean, it seems like your location, being a California bank, that in and of itself gives you this great closeness to Silicon Valley. Has that benefited Wells Fargo more than other banks in terms of data center financing?
Yeah, we're a national bank. I mean, we've got large presences in San Francisco, Los Angeles, Minneapolis, Des Moines, Dallas, New York, lots of places. And our customer base is very broad. But I think the most important thing for us in terms of how we position ourselves in this is we've had relationships for a long, long time. We've banked them. We've lent companies money of all sizes and all types. And we've got the expertise inside to work with those and bring people together. And so that's really the opportunity for us.
Can you convey or characterize the enormity of it? The lending to...
It's going to be trillions of dollars, whether it's $3 to $5 trillion, that's going to be needed to build out the infrastructure. And again, what we understand is there are huge benefits for AI. I mean, huge risks and huge benefits. And the question is, what's the business model going to look like to support all that spending? And again, not everyone is going to get it right. The hyperscalers have a huge advantage. Those who control these large language models that continue to be on the forefront, continue to invest, people are going to pay for that. And what's strange at this point is there's not this clear understanding of what that business model looks like. So you're doing a little bit on the come, but you have to. There's no question that the benefits are there. It's very real.
Let me get your take on what you're doing at Wells Fargo. I mean, a real leadership pivot in terms of where your priorities are, I think. And of course, you recently had the asset cap and regulatory orders lifted at the bank. What are the big opportunities for you at Wells Fargo right now that you've got this lifted asset cap constraint away?
You know, I think about it like we are blessed with this amazing franchise at Wells. On the consumer side, our middle market franchise, our wealth franchise, our corporate investment bank. And even though we've had this amazing franchise, we've been operating on an unlevel playing field now for a very long time because as a bank, we lend, we take deposits, we provide other services, but we haven't been able to grow. And so there's been a limitation on what we can do for our customers. And so now being able to compete on a level playing field opens up the opportunity to serve customers in ways. So that means lending more, for sure. It means taking deposits that we weren't able to take in the past, and then using that broad set of capabilities to be able to just more deeply penetrate consumers and businesses. So we're incredibly excited about our opportunities to grow all of our businesses.
So does this open you up to perhaps acquire a regional bank?
You know, we're not focused on acquisitions at this point. I think we're in a very unique position. We have this amazing franchise. We've been constrained. We don't feel the need to do any M&A whatsoever. We have a complete business with scale, depth and breadth of everything that we do. And so we have this great opportunity to grow organically. And so other people are in different positions. We're lucky to be in this position of having these opportunities with what we have.
Talk to us about the regulatory backdrop in terms of the credit card business. The president came out with this idea to have a 10% cap on credit card rates. Do you think that materializes, and how does that impact things?
Yeah, listen, I think the president is right to focus on affordability. I mean, that's where he is. He has, suggests lots of things in terms of how to get there. I would say, the administration broadly and the president is very, very open-minded towards trying to figure out what the best solutions are. I personally don't think that is the best solution. I think there are other things that we can all do to help with affordability. And that's the conversation that we engage when we talk with the administration and lawmakers.
Yeah, but I mean, one analyst said that, if that goes into effect, it's going to cut earnings between 6 and 18%. How much of an impact does that have on Wells Fargo?
I'm not worried about the impact on Wells Fargo. I mean, we have an important credit card business. It's not the biggest part of the company, even though we think we've got great opportunity. I'm much more concerned with, is it the right answer for helping Americans who are in need? And does it actually help extend more credit or extend less credit? And my fear is that it actually hurts the extension of credit.
Very good point. Yeah. Okay, let me get your take then on markets and the opportunity there. Because I think you at the KBW, or one of your colleagues at the KBW conference recently, said that this is a huge opportunity now to grow your markets business. How do you do that?
I think you got to put it in perspective, which is, as a bank that served companies of all sizes, that's the genesis of what we've been. Right. We started out very locally. All these banks came together. We serve consumers, we serve small businesses, and we serve large businesses. And as they've grown, we continue to do that. So we lend to the Fortune 500, we manage their cash, we give them advice. And at the heart of what we do is we help provide them capital. And so the idea that we're going to continue to grow out our investment banking and trading capabilities is just a continuation of being able to give access to capital for the relationships that we already have. And so we're incredibly excited about the quality of the people that we've been able to bring into the company, letting the great people that have been there have access to more resources to grow. And you see the impact. I mean, we've gone from, I think it's, 2.7 to 4.4%, market share in M&A. We were involved in 2 of the biggest M&A deals last year, 4 of the biggest 10. It's going to be lumpy for sure. We're growing our equity franchise. We're growing our leverage finance franchise. We're serving sponsors, but it's not something new. It's a continuation of what we do and what our clients expect from us.
So is it about getting the right people, continuing to gain more of the right people to actually, increase that business, M&A, increase the number of IPOs that you can do. That's the business, that's the big opportunity.
It's a combination of getting the right people, making sure we're coordinated across the institution. So as you develop a primary business in the underwriting side, you need a secondary business to support that. You can't do one without the other. Research matters. All these things come together to help build what is a more complete franchise. And we have to be willing as a management team to commit the resources. And that could be hiring people, it could be paying people properly, it could be balance sheet. But I would say all in the context of what's right from a risk perspective for Wells Fargo. We're not looking to exponentially change the risk profile of the company. We're looking to continue to build upon what we've built over a long period of time in a very rational way. I
want to get your take on the proposals out of the Federal Reserve. We spoke with Mickey Bowman here last week, and she talked a little about the capital proposals that she's put out. Here she is, watch.
We want to make sure that banks actually can engage in those activities without being disincentivized based on regulatory constraints. What we've seen over the years since these rules were put in place after Dodd-Frank, we've seen a lot of business that's traditional banking activity exit into the non-bank space. And this is one way for us to recalibrate that, to encourage banks to get back into those traditional banking activities.
So what does this mean for you in terms of managing capital post these Basel III rules?
Well, first of all, I should say, I think the way they're going about this analysis on capital is exactly what you would want, which is they're not thinking about it politically. They are not drawing conclusions just because of what someone whispers in their ear. They're doing economic studies. They're looking at what they think is best for the safety and soundness of the system and what's going to help banks support the growth of the economy. And so, putting out, several hundred pages of economic analysis to support what they've done is incredibly important. Putting it out for comment for the public to see, engaging in all types is just exactly what you'd want to see. Ultimately, what it's going to allow us to do, it's going to allow us to serve more consumers and more businesses. I mean, when you look at the risk weighting changes that are proposed on mortgages, on auto loans, on loans to middle market companies in this country, it much more aligns with our view of the risk profile of those underlying assets. We still have incredibly strong capital requirements. We still have, substantially more capital than we had during the financial crisis. But it's a very prudent way of marrying up safety and soundness and making sure that the banks are positioned to drive economic growth.
So do you change the way you manage capital? I mean, right now, you've got a CET1 ratio of 150, 200 basis points above the required 8.5% level. Do you change that? Do you pull that in?
Well, I think over time we probably will operate with slightly lower capital levels because we've had this very big buffer not knowing what's going to happen to capital, right? Last administration wanted to increase capital materially. Now we see where this is. So once it's done, we'll be able to be more definitive what we want to do. And what we'd love to do is not just buy stock back and increase dividends, but to actually use it to support our customers. And we've been hindered because of the asset cap, not just because of capital requirements in the past to do that. So for us, it's an incredibly exciting time to be able to deploy all this capital into supporting customers.
Yeah, I liked your comment the other day, the world is your oyster, I think you said. Let me get your take, Charlie, on private credit. You mentioned this earlier, and people are worried about the bank's exposure to private credit through your non-depository financial institutions loans category. What can you tell us there? How exposed is Wells Fargo to this area of the market?
So first of all, I think private credit is, gotten it's very complicated set of conversations because people are confusing liquidity, they're confusing credit, they're confusing mistakes that get made in underwriting, which aren't systemic. And then there's what it ultimately means to retail investors that have been buying this. And so when you just think about just liquidity for a second, right, which is most of what you're hearing in the news today, it has nothing to do with credit. It has to do with people who are nervous about what's going on, partially because of some mistakes in underwriting away from the private credit market, partially because of a fear of what happens in software companies. But the fact is, a lot of people have invested in products that they think are semi-liquid, and there's no such thing. There's either liquidity or there's not liquidity.
Right.
And people are coming to terms with that, and that's okay. And you'll wind up with people that can handle that. Then in terms of pure credit, the reality is credit is still very, very good. Now, there's a lot of credit that's been extended in the private credit space. A bunch of that's been supported by banks, but it's like all credit, and it's not all created equally. There's some really smart people out there who've been through cycles, who do it really, really well, who've got diversification within their portfolios. They've got low leverage ratios. And those are the folks that we try and bank, and those folks will do really well through this. There are others that, with a flight of capital that's come through both institutions and retail, looking to deploy assets, haven't been as good. There'll be some losses there. But we don't really see those yet today. In fact, what we actually see is relative strength continuing. You got nervousness because of the view of what software companies and what their future looks like. And you've got this view of there have been some credit mistakes that have been made.
Yeah.
But they're not systemic yet, and they're not systemic to an institution or the marketplace.
Right.
And so when we look at our book, it's very diversified. Most of what we do is subscription finance, where you're really lending to funds, which is backed by the large institutions that support it. And then we look loan by loan in terms of when we finance an individual company, and hopefully we'll do it as well as we think we do.
Charlie,
doesn't mean we're not going to make mistakes.
Thank you so much, Charlie Scharf, joining us. We'll be right back. Stay with us.